Welcome to the Investing Podcast presented by TUUUQ Media. This is Outsider Trading, an audio and video deep dive into the people, places, and things that we find most interesting in the market.
Hey everybody, welcome back to the Investing Podcast presented by TUUUQ Media. Before we get started, go to Twitter, follow us at TUUUQ Media LLC. Check us out on Facebook, facebook.com/TUUUQ Media LLC. I'm Andrew Hall. Joining me, as always, Ben Nye. Ben, how was the weekend?
It was good. It was good. Cool weather.
Yeah, it felt great.
Yeah.
Very much enjoyed it. Did a little fire outside. Finally had
Nice.
a reason to warm up outside.
It was incredible because Thursday night was just so hot.
Yeah. We went to a little charity hoedown type thing, Western themed, and just sweating bullets.
Yeah.
And then Friday, all of a sudden, it felt fantastic.
Yeah.
So I was hoping for more cool weather. It's pretty cool right now. I was actually looking, it's going to get up to like 82, I think, today.
Oh, really?
So yeah, it's warming back up, but we will jump in, speaking of warm, the market.
Yeah.
Futures up nicely. Dow futures up 42 basis points. S&P up 45 basis points. So that's 0.45%. NASDAQ futures up almost 60 basis points. So nice little run there. Gold down about 0.5%. Oil down almost 0.75%. So kind of an interesting day. Lots of big news with mergers and all that good stuff. But we're going to actually start off talking a little bit about commodities, talking about oil, and some of the big themes that we've talked about over the last, year or so are things like oil production, bankruptcies for some of these smaller companies that are producing oil, and you want to share a little bit about kind of some of the inconsistencies or maybe the stubbornness of these companies.
Right. So one of the big points is that, so first of all, there's when a company goes bankrupt, it's not like the company just disappears. Which I think a lot of people, that there's this kind of mental heuristic that kind of thinks that, like they see, Borders just disappeared.
Right.
But that's not entirely the case.
It's not that easy.
So what happens in bankruptcy, like you go through reorganization and you negotiate your debt, and a lot of times the debt owners become the owners of the new equity holders of the company. So what happens is, and because the company is worth more producing oil or any commodity than if it wasn't, they could just continue to produce. So what's interesting, the Wall Street Journal this morning came out with an article that said, 70 oil and gas firms have gone bankrupt, and they produce about 1 million barrels of oil and gas a day. And that's about the same that they produced prior to the bankruptcy. The same is being true in coal. We've seen a number of bankruptcies there. Interestingly, if you want to take a flyer on that coal stock, BTU, which is now under BTUUQ. So you got to watch out for those Q shares. They report earnings this week, and they're bankrupt. They're going through a reorganization, but their shares have just been flying last week or two. So keep an eye out for them. That could be an interesting indicator of something in the commodity space.
Yeah, it's kind of interesting. I mean, when you take a step back and you separate yourself from what you would maybe assume would happen with a bankruptcy, and you actually put yourself kind of in the position of the debtors, those that are collecting on the debt, rather. It's kind of an interesting thing because it actually makes a lot of sense. Because at the end of the day, if Ben owes me money, and let's just say for the case of this illustration, the only way Ben makes money is from podcasts. If he owes me money and he can no longer pay me the money he owes, and I now get a fraction of ownership of TUUUQ Media and the investing podcast and all that, the last thing I'm going to want Ben to do is stop podcasting.
Right.
And I'm self-interested, and Ben's self-interested, and so he knows, okay, well, it's going to get a whole lot uglier if I stop podcasting. So I'm going to want him to keep podcasting. And if there's an oversupply of podcasting, I don't really care. I want to make sure I'm getting my money in from that. So you kind of have that at play, and it kind of touches on the theme of what we've talked about with OPEC when we talk about, who is actually going to scale back on production. It sounds great theoretically, but if we're saying, somebody's got to cut back on podcasting, there's too many podcasters. If we're making money on it, I don't want to cut back. Right. I don't want you to cut back if I now have an equity stake through this reorganization of bankruptcy. So that's kind of the illustration. Again, it sounds weird. Why would they keep operating if they're not liquid? Well, that's why.
And the other layer you have on top of that is that there's so much money just sitting in private equity funds on the sideline. I've seen numbers that range over $100 billion just ready to be deployed into these difficult energy stocks. But what happens when private equity buys that? You know, they're going to do exactly the same thing. They're going to lever up and they're going to produce as much as they can to produce a return as quickly as possible. And so that's not going to keep a lid on production like people may think or may want to think.
Yeah.
So
That's great. That's great. So other big headline really coming out of the weekend, coming into Monday, is all these mergers, these acquisitions. Acquisition Monday.
Right.
MarketWatch was calling it this morning an actual rare appropriate title for MarketWatch, which was kind of interesting.
They didn't get the alliteration though. I think a lot of people try to say merger Monday, but today not so much a merger, definitely acquisition.
First thing we'll talk about, and we talked about this on a video that went up Friday, and I think the post on Seeking Alpha went up over the weekend, but NXPI and Qualcomm, deal's going through, at least as of right now. It sounds like it's going to go through.
Right.
Agreed upon price for Qualcomm to acquire NXPI is 110. I mean, for starters, good acquisition, bad acquisition?
Yeah, I think it's a great acquisition for Qualcomm. They need growth.
Mm-hmm.
The problem is as they're so levered to phones, and as phone sales have matured, then so is their business. And so when volume dries up and price and technology always goes down, so they're seeing a little bit of top line pressure to historical growth rates. So they need to reinvigorate that. Now, NXPI has that in abundance. The question I have for NXPI is why are they doing a deal at 110 when some analysts were saying 130, 140.
Right.
Initially they were saying like 110, Qualcomm wanted 110 and they wanted 130. Then they wanted 110, Qualcomm wanted 110 and NXPI wanted 120. And now a deal went through at 110. Like, that's not good negotiating.
Not good negotiating. It was kind of odd because, I mean, my first instinct was, okay, the 110 was the standing and speculated offer. 120, once that was the point that was desired by NXPI, that's not a big jump.
No.
That just seemed totally reasonable. Kind of seemed like standard, okay, 110, no, 130, okay, 120.
Right.
Kind of that normal meet in the middle ground. That seemed completely reasonable. And kind of along those lines, I mean, I do think you still have some shareholders that aren't thrilled with that. The stock has not bounced the way you would have expected. We had an initial spike, a couple of weeks ago when this started getting floated out there, but hovering around 102 thereabouts the share is, and you'd expect that gap to close, but on one hand, it doesn't have a whole lot of way to close.
Right. Well, I think what you might see is some shareholder lawsuits saying, we paid the board of directors of NXPI to get the best deal that we can and maximize shareholder value, and we're not seeing that when you go from 130 to 110 from a negotiating position. So difficult to know. Is there something going on with the underlying business that people aren't aware of that we might find out in the next couple of weeks as they report earnings, or do they just want to get out of the business and take their golden parachutes?
Yeah, and it's kind of an odd play as well, and I think you're exactly that. Like, what are we going to find out during earnings? Because at the same time, I think you're exactly right in that Qualcomm needed help from the top line. They needed to kind of get away from solely focusing on phones. And NXPI, in that regard, held all the cards and literally didn't get anywhere with it. Like, nowhere. It's not even like they got $111 a share.
Yeah.
It was 110. So kind of an odd space. And the other side of it is, this is almost clouded by the next deal that we're going to talk about, but it was a relatively quick progression.
Yeah.
There wasn't really a timetable, at least not that we're aware of, for NXPI to have to move right this moment.
And it's all cash too, so it's not like NXPI is getting upside in the combined company. I get that they may feel like they're being diluted with a lower growth Qualcomm. Nevertheless, if you're doing an acquisition at a somewhat lower price than you want, because you believe in the synergies of the combined company, then
you'd want stock.
You probably want stock.
Yeah. So kind of an interesting place to be. Again, there is upside relative to the trading price of NXPI, so we don't want to totally ignore that. But that's there. The bigger deal that everybody's talking about, and everybody's been talking about through these whole 3 or 4 days since this started coming out, is AT&T acquiring Time Warner. It's an $85.4 billion acquisition. Pretty sizable. Biggest thing to me is just how quickly this happened. We did a video on Friday. Again, if you go to YouTube, search Tusk Media, you can find that. If you go to Seeking Alpha, it's up there, I think, under the premium content. So I think you have to have a membership or what have you to check that out. But crazy how quickly this deal got done. I feel like I left work Friday thinking, man, this is wild, but still not really thinking a deal would get done over the weekend. And Saturday night, boom, there you have it.
I didn't. Quite honestly, I did not buy it at all. I did not think this deal was happening especially so quickly. I'm not sure if they're trying to get it in before the election. If they are, I mean, it seems like that's not working because there
Right.
are political ramifications that we're reading about this morning.
Yeah.
But you know, the deal's not supposed to close until September or December.
December of 17.
December 2017.
So it's kind of one of those hurry up and slow down things.
Yeah.
Which it does seem like they're trying to push it through prior to the election. We're going to talk about kind of the political ramifications here shortly. But it's odd. It
Right.
was so quick. One of the biggest deals of this kind we can talk about. And
Do you think it's a good deal for AT&T?
I don't know. That's part of it. And some of it is almost the newness. I'm not quite sure.
Yeah.
I do think they overpaid a little bit.
Yeah.
I mean, they paid a steep premium on this for a company that's Time Warner's really kind of had a pretty nice run up till now anyway. So I think to go above and beyond that.
Well, a lot of people say, you know, content is king, content is king, content is king. But I mean, how long can you produce that same content? I mean, that it's under the premise of that this content is going to be continued to be produced. I know a lot of people said, because people point to the HBO asset as kind of the crown jewel.
Right,
of Time
certainly.
Warner. But people talked about ESPN as being the
Right.
crown jewel of
Right.
Disney for the longest time, and now ESPN is the weak spot in the company.
Mhm.
So, you know, if you're buying HBO essentially
Right.
at the top point in its popularity,
At a huge premium.
at a
above
huge
that.
premium, I mean, is that really the best acquisition that you can do?
Seems like a true bubble acquisition. And the other side of it is, I mean, it's not, you can't quite compare apples to apples, but it's almost like, well, think of all the content AT&T could have created for
Right.
$85 billion.
I know. I mean, how much has Netflix invested? I mean, probably a fraction of
Right.
that, and they're pouring out content all
Yeah.
the time.
So it just seems like there could have been another way around it. And then the synergies, it's almost hard to anticipate what's
Yeah.
going to be there. Obviously, you have AT&T getting into the television programming space with DirecTV and all of that, and you know, all the Uverse and all that stuff.
Right.
Which I have a long rant about. I think just pro tip here to AT&T: you could give everyone free television and internet with the amount of money you spend sending flyers to My Home Alone. Like you spend at least like $40 a month on advertisements coming to my home. So just a little pro tip: maybe cut back.
Right. I mean, it seems to me like AT&T is almost going after Comcast.
Yep.
In terms of its competition. You know,
Mhm.
Comcast acquired NBC Universal. They're kind of vertically integrated that way. AT&T trying to go the same way, but carrying a lot of debt, requiring a lot of stuff to go right, and now they don't have. I mean, they don't have the capital to go out. It's cheap capital.
Right.
To go out and buy Spectrum, which is their pipe.
Right.
Because they don't have the pipe directly to the home like the cable companies do. They have to buy Spectrum.
Mm-hmm.
And so Verizon has the lead in that right now,
Yeah.
and it's difficult to see AT&T catching them up
Mm-hmm.
when AT&T is going out and
All
spending
that.
all that money
Yeah.
on media acquisition.
Yeah, it's kind of wild, and we're going to come back a little bit to the AT&T Time Warner acquisition in just a minute. But one more acquisition to talk a little bit about: TD Ameritrade buying Scottrade, a $4 billion purchase. They kind of fragmented this out. They said they're paying $2.7 billion in stock and cash for the brokerage business, and then the rest of it's basically going towards the banking business. Kind of interesting because on the retail side, I mean, this certainly positions TD Ameritrade to kind of be a giant in the room.
Right.
And it's an interesting, I don't know, we're always interested in brokerage models and things like that, just given our business and what we do on a day-to-day basis. But it's kind of an interesting approach, I feel, because what we've seen is just this kind of consistent march ever since really like the E-Trade baby era of low-cost providers on the retail
Right.
side. And on one hand, you pick up that scale, but then you almost wonder, are they going to gain any pricing power with that? Because that almost seems like what needs to turn around for these things to be really successful, is to be able to actually control a big enough share of the market that you can actually incrementally increase transaction fees to those operating in the retail space. So that's kind of the storyline to me, is do they get enough volume that they can actually control that?
I think a lot of what's happening at these brokerages is that a lot of the kind of the older mainstays like the TD Ameritrades, like the Schwabs, have underinvested in technology and have not been able to move the technology forward fast enough. I know TD Ameritrade came up with the Thinkorswim, but I believe that was acquired as well.
Mm-hmm.
The platform for that was acquired. So now they're acquiring Scottrade, which I think is generally considered to have a better kind of an online, interface, technology interface. So TD Ameritrade really trying to move that. I used TD Ameritrade Institutional at my previous employer, and that was, it was a decent platform, but it was clear that it wasn't as intuitive as a lot of the retail brokerages that most people are accustomed to using. So it seems like TD Ameritrade buying in order to catch up.
Yeah.
I don't think this is a acquisition to really move ahead. I think it's an acquisition more to catch up.
Yeah, so try to stay relevant in that
Exactly.
space, or get relevant perhaps, as opposed to stay relevant. So kind of an interesting acquisition, and I think it also creates a nice framework for maybe a broader political discussion, which is really the reaction that we're getting to these major deals. A couple quotes here specific to AT&T and Time Warner. Donald Trump, Republican candidate for president, says that this creates, quote, too much concentration of power. Tim Kaine, vice president candidate on the Democratic side, Hillary Clinton has not weighed in yet, but says that this gives him, quote, concerns and questions, which is pretty appropriate for the guy that everybody calls America's stepdad. So it gives him some concerns and questions. Meanwhile, Bernie Sanders, who is somehow still relevant, I guess, in this conversation, says that this is going to give too much pricing power and is going to concentrate power too much, which is interesting coming from a socialist. He's very against concentrated power, apparently. But a lot of pushback on that deal, which is interesting because it does, and you and I talked a little bit about this, whether it's a good decision, bad decision, quick, slow, right price, what have you, it is very much a vertical integration here. We're actually seeing somebody buying a complementary service that they think can cast their net broader. But to say that it's really going to limit competition, especially when you already have kind of a proven example of, NBC Universal being acquired by a competitor, I think that's kind of a stretch from my perspective. Meanwhile, you have two deals where you actually have, Qualcomm buying NXPI, much more horizontal right there. And then on the other side, you have actual brokerages being bought and brought together. Those deals seem to be more likely to limit competition. And kind of to my point earlier in terms of, Scottrade coming under TD Ameritrade, that actually seems like they might actually gain some pricing power and actually increase the prices directly, which is kind of odd. But what are your thoughts on how much pushback are we going to get, especially on this bigger deal with AT&T and Time Warner?
Boy, it's a big question. I think that AT&T's probably got to set aside probably another $1 billion for lobbying over the next few weeks, and you'll see those politicians turn.
Oh yeah, it'll be quick.
But what I would say is just that it makes sense that people are kind of glomming onto this idea of any consumer-facing company that's going through an M&A type transaction is gonna get pushback. I feel. I think if you're a little more removed from the consumer and you're not a brand that people know about, I don't think politicians are really going to care about it too much.
So nobody's upset about NXPI.
Exactly. Because people don't see that that transaction resulting in higher car prices, for instance, or phone prices.
Right.
But in terms of AT&T and Time Warner, like these are brands that everyone knows about. It's getting huge headlines.
Everybody hates them.
Everyone hates them. And although they might say AT&T's customer service is not quite as bad as Comcast.
It's not as bad. Nothing's as bad as Comcast.
Nevertheless, it's just going to get so much pushback in the interim. But I think you get some of the lobbying money. I think you get out of the election time frame, and I think it becomes easier to get through. And under it's really difficult to see it not going through under Republican administration, but those comments out of Donald Trump just sound like he's trying to get ahead of Hillary.
It's populist. Yeah.
I think he's just trying to get ahead of Hillary on it.
The last question I have on this, and then we'll kind of switch gears, but the December 2017 close date is just odd.
Right.
Do you think there's any chance that you're going to try to push that up? Because part of me says it doesn't matter who's in office, the longer the window of this thing, the more trouble we're going to see. It just seems like the longer you push out anything, it's almost like that couple that's been engaged for 4.5 years. So you're kind of like, are you really actually going to do this thing? I don't know. But I don't know if you have any thoughts on
just the history of deals actually going through before when they said they were going to go through is just extremely thin. So I would actually say that this would actually take longer than expected. If it wasn't by December 2017, I think it would be later.
Well, by then, it's going to be.
But if it's not fourth quarter of 2017, I think it'll be later. It's difficult to see before fourth quarter.
Yeah. So last thing we'll do, totally switching gears. Citizens Financial reported last week. We updated our kind of thoughts on it in our portfolio management meetings last week, but did not get a chance to talk about it on the podcast. So talk to us a little bit about what we saw there.
Yeah, so Citizens Financial Group spun off of RBS a few years ago. And as part of RBS, they just were not operated well at all. RBS kind of just used them as a bag holder for the company and then just got rid of them in order to improve their capital. So Citizens Financial Group came public and they were actually under levered, which was kind of interesting. So they've been working on improving the leverage and improving the
increasing
ROE.
leverage in that case,
Increasing
which is
leverage,
odd.
yeah. So their ROA has lagged, so their return on assets has lagged, but also their assets to equity ratio has lagged. And as a result of that, the ROE has severely lagged. So that's why you were seeing them trade. Right now they're still slightly below tangible book value, but just a couple months ago they were like 20%, 25% discount to tangible book value. And they'd been there for quite a while because people did not think that they would actually ever make money off of that tangible book. They just viewed them as terrible operators. But I think one thing that we've found over the last, any number of years is that banks are best measured by their book value, by their tangible book value, because bad banks tend to become average and good banks tend to become average. We've seen that most recently with Wells Fargo.
Right.
People said it was just extremely well-run bank, and then a shoe drops, and then so do the shares. So, Citizens Financial Group, one of the most interesting things about them is that they're extremely highly levered. In fact, one of the most levered banks that I know of to an interest rate hike by the Federal Reserve. So it's a nice position as a call option on that, because that can really improve their ROE as they're investing in these higher yielding.
Which we tend to think, when the interest rates go up, we tend to think the financial sector is going to benefit as a whole, because all of a sudden you kind of, we've actually, I remember way back in the day when I was in my old office just doing this, I almost used it as an illustration of, hey, if you're paying this much directly to the interest rate, the bank can tack on this. But if you double that, all of a sudden the bank can kind of tack on a little bit more, start to widen that. But you're saying that CFG is actually even more exposed to benefit from a rate hike.
Exactly. And so when people think that a rate hike is going to happen like they do in December, CFG shares tend to appreciate. When we actually purchase the shares, so we're still long the stock, sold a little bit last week actually before they reported, unfortunately. But we actually bought the stock as kind of an option on interest rates because we viewed them as, if nothing happens, they're probably going to be about static at this tangible book value. It's not going to be very exciting. But if the Federal Reserve starts to pop interest rates, then you could really see them.
Which we're told they will at some point. Yeah. We're told that.
Yeah, for the last 5 years.
Yeah, we're just waiting.
So they came out with earnings. The biggest issue for them has been the fee income. People kind of say, net interest margins, they're going to do what they're going to do. Biggest issue for them has been fee income. They improved that a bit. It's all about getting the right employees on, getting those mortgage originations up, for instance. Expanded their workforce a little bit. But interestingly, what actually drove the beat was better performance on net interest margins than expected. They also had a little bit higher loan growth than expected. Not the substantial acceleration that we'd like to see, and it's coming from the net interest side, which that's not going to do much unless it's difficult to read through into a permanent improvement because of that, unless the Fed starts to raise rates. Biggest issue for them, fee income, kind of just as expected. They're slowly moving in the right direction, but it's not that acceleration that we'd like to see to dramatically change our price targets. So a good quarter from them, but we're going to have to see more in the coming quarters.
There you go. So we'll keep you guys updated on CFG, which again is a position that we hold. That's all we got. Interesting week coming up. So hit subscribe on YouTube, iTunes, search out Tusk Media.
Speaking of iTunes, actually, we got an Apple preview coming up tomorrow or Wednesday.
Yeah, so we're going to do that. We're actually going to be out of town for a couple days, so we're going to try to hit 3 or 4 stock previews that will actually be scheduled to go up. So hit subscribe because it may not be quite like the normal time.
Right.
So if you're used to getting into work and checking out our stuff first thing, maybe hit subscribe so that it just hits you with it, because we're going to do that. And then I think we'll probably have a pretty good podcast on Friday when we're back from the conference towards the end of the week. Kind of talk about some investable ideas we picked up.
Right.
So there we go. Y'all have a great day. Talk to you soon.
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are our professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.